Four companies now control 90% of America's food supply. Yet supermarket prices are rising at the fastest pace since February 1974, a violent contradiction hiding in plain sight. Investors call it efficiency. The numbers prove something else entirely. The latest USDA index shows a 37% surge in food sector concentration, worse than the monopolistic peak seen months before the 1929 crash, and far beyond the vertical integration thresholds that triggered the 2008 commodity spike. But the present danger is far more extreme. On August 12, 2024, food sector margin debt quietly hit $684 billion, surpassing dot-com-era leverage and signaling a system already cracking beneath its own consolidation. The numbers were worse than 1929. The illusion of stability is the real threat. Quiet aisles, full shelves, normal prices, all masking a cartelized structure primed to fail the moment supply tightens. This wasn't speculation. It was mathematics. This collapse is mathematical. On the surface, America's food system looks stable. Full shelves, stable brands, predictable aisles. Consumers see normality in every transaction, comfort in every checkout line. But beneath that calm, for companies quietly tightened their grip until they controlled 90% of meat processing, 85% of grain trading, and 70% of packaged staples. The charts showed collapse-level concentration while shoppers remained oblivious. What no one noticed was the structural breach hiding in regulatory filings. The 2024 Hirschman Index for Food Distribution hit 2,740, higher than the concentration levels seen before the 1929 retail collapse and far exceeding the monopoly thresholds that triggered antitrust intervention in every previous era. This wasn't gradual consolidation. This was systemic capture. Then the deeper contradiction emerged from price data. Volatility surged 19% despite record corporate profits, a divergence only seen in 2008, months before the commodity shock that sent wheat prices up 130% in 18 weeks. The pattern was unmistakable to anyone examining the spread between wholesale costs and retail prices. Margins widened while supply chains tightened, a combination that historically precedes catastrophic price spirals. The system was already cracking. Behind closed doors, industry executives understood the fragility. One leaked Cargill internal memo from March 2024 noted, "Market concentration has exceeded sustainable thresholds." The language was careful, but the implication was clear. When four firms control 9/10 of supply, a single failure cascades instantly. There are no backup systems, no alternative channels, no redundancy. Just-in-time efficiency had eliminated every buffer that once protected against disruption. History was repeating in real time. Concentration this high always ends the same way: shortages, price spirals, and structural failure. The mathematics of monopoly systems are unforgiving. When competition disappears, price discovery fails. When price discovery fails, allocation breaks down. When allocation breaks down, the entire distribution network seizes. The system was already cracking. Euphoric analysts claimed consolidation made food efficient. Industry reports celebrated economies of scale and streamlined operations. Wall Street rewarded the trend with rising valuations. The narrative felt compelling, supported by stable prices and steady availability. But the data proved the opposite. From 2021 through 2024, food inflation rose 23%, while the top four companies' profit margins exploded 41%, a divergence worse than the run-up to the dot-com energy shock, when utility monopolies extracted record profits before the California grid collapsed in 2000 to 2001. But the real danger was leverage. By mid-2024, the sector's combined debt load exceeded $1.2 trillion, surpassing debt levels seen in housing markets in 2006, 2 full years before the crash. This wasn't a warning signal. This was a replication of the exact pattern that destroyed Lehman Brothers, Bear Stearns, and Washington Mutual. The same ratio of debt to tangible assets, the same reliance on short-term refinancing, the same assumption that markets would remain liquid forever. This wasn't speculation. It was mathematics. One more break appeared in producer economics. Wholesale to retail spreads widened beyond 2008 thresholds, meaning farmers earned less even as grocery prices climbed. The gap between what producers received and what consumers paid hit 47%, exceeding the record set during the 1973 stagflation crisis. Farmers were being squeezed from below, while monopolies extracted maximum value from above. Another pre-crash pattern, perfectly preserved. Federal Reserve economists noted the distortion in a June 2024 report. Price transmission mechanisms have broken down across agricultural markets. Translation: the system no longer functioned as a market. It functioned as an extraction machine, optimized for short-term profits while hollowing out long-term sustainability. Every major bubble begins with the same divorce between cost and price. The math matched every pre-collapse era. The food system looked boring, safe, ordinary. Financial media ignored it in favor of tech stocks and cryptocurrency drama. But boring is how crises hide, camouflaged by familiarity until the structure suddenly gives way. Beneath the surface, derivatives tied to commodity futures ballooned to $19 trillion in notional exposure, higher than pre-2008 agricultural derivatives and exceeding the volatility buffers calibrated since 1991. The leverage was invisible to consumers, but starkly visible in futures markets, where open interest in wheat, corn, and soy contracts surged to record levels while actual physical inventories declined. But the deeper fracture was inventory fragility. The average U.S. supermarket now holds only 3 days of food, down from 10 days in the 1980s, and 5 days in the early 2000s, a collapse in resilience never seen before in peacetime. Just-in-time logistics eliminated warehousing costs, but also eliminated buffers. One supply disruption now meant immediate shortages, with no strategic reserves to cushion the impact. The contradiction sharpened. Consolidation skyrocketed while buffer capacity fell. The structure couldn't survive a disruption. Every efficiency gain came at the cost of resilience. Every margin improvement came from cutting safety redundancies. The system was optimized for perfect conditions and catastrophically vulnerable to any deviation. The system was already cracking. Historical comparison revealed the danger in stark terms. Commodity leverage now exceeded the levels that triggered the 1973 food crisis, when fertilizer shortages and grain export restrictions combined to send prices up 300% in months. But today's metrics were worse on every axis. More leverage, less inventory, higher concentration, greater fragility. The structure was tighter, more brittle, more prone to sudden failure. A supply shock today cascades faster than any point in the last century. And then it got worse. In the 1990s, no single company held more than 10% of any food category. Distribution was regional, competitive, fragmented. Dozens of processors competed in every market segment. But by 2024, 4 firms dominated up to 90% of critical categories. Tyson, JBS, Cargill, and National Beef controlled meat. Archer Daniels Midland, Bunge, Cargill, and Louis Dreyfus ruled grain. A handful of conglomerates owned packaged goods. Analysts called it normal industry maturation. The Federal Reserve labeled it structurally dangerous in a confidential 2023 memo that leaked in early 2024. Supply concentration magnifies systemic vulnerability and reduces market resilience. The shock came when cross-ownership analysis revealed that 2 major investment firms, BlackRock and Vanguard, controlled 68% of voting power across all 4 dominant meat processors. This wasn't just consolidation. This was coordinated control, a network of interlocking ownership that eliminated true competition. Prices moved in lockstep because the same shareholders controlled every major player. This level of vertical control was worse than the railroad monopolies of 1907 that triggered the panic, and worse than the energy concentration of 2008 that amplified the financial crisis when commodity speculation merged with corporate consolidation. The numbers were worse than 1929. Antitrust enforcement had collapsed. The last major food sector merger challenge occurred in 2001. Since then, regulators approved every consolidation, every acquisition, every vertical integration scheme. The Herfindahl-Hirschman Index, the standard measure of market concentration, screamed monopoly danger, yet no action followed. Political capture was complete. Monopoly doesn't stabilize the system. It accelerates the crash. When one firm fails in a competitive market, others absorb the slack. When one firm fails in a cartel, The entire structure collapses because no alternatives exist. The mathematics are unforgiving. The structure was top-heavy and tilting. Shipping volumes looked stable in aggregate data, masking dangerous regional dependencies beneath the surface averages. But detailed analysis exposed structural vulnerability. The United States now imported 52% of its fruits, 32% of its vegetables, and 94% of its seafood. Exposure levels unseen since World War II rationing when German U-boats threatened Atlantic supply lines. Domestic production had collapsed across categories, replaced by cheaper foreign sources that left American consumers dependent on global logistics networks stretching across oceans and continents. Then came the metric that changed everything. The 2024 Global Food Supply Stress Index, measuring port congestion, shipping costs, inventory levels, and geopolitical risk, hit 1.92, surpassing the reading from October 2007, exactly 1 month before the global liquidity freeze began. The parallel was exact. Stress built invisibly until a single trigger released cascade failure. One more breach appeared in fertilizer markets. The price index jumped 71% in 18 months, from $580 per ton in January 2023 to $992 by July 2024. That spike mirrored the one that preceded the 1973 food inflation shock, when OPEC oil embargoes disrupted ammonia production and sent crop yields plummeting. But today's spike was faster, steeper, and occurred against a backdrop of already strained supply chains. History was repeating in real time. Geopolitical tensions accelerated the risk. China controlled 30% of global fertilizer production. Russia dominated wheat exports. Any disruption in either nation cascaded globally, and both faced escalating sanctions, trade restrictions, and diplomatic isolation. The system was fragile by design, dependent on continued cooperation between rival powers with diverging interests. When imports choke, monopolies amplify the shock. Diversification provides resilience, but consolidation eliminated diversification. For companies controlled import channels, and those channels depended on stable geopolitics, an assumption growing less valid by the quarter. The global system was buckling. In late 2023, trading volume in wheat, corn, and soy futures hit record highs as algorithmic systems and speculative funds poured into commodity markets. On the surface, this looked like healthy liquidity and robust price discovery. But open interest, the number of outstanding contracts, collapsed simultaneously, falling 23% even as daily volumes surged. This divergence was the same one that preceded the 2008 commodity super spike, when speculative positioning overwhelmed physical supply and sent prices parabolic before crashing violently. Then the unavoidable comparison emerged from CFTC data. Today's speculative positioning exceeded 2007 levels by 34%, meaning the bubble was bigger before the crack. Managed money, hedge funds, and commodity trading advisors held net long positions equivalent to 187% of annual U.S. wheat production. When these positions unwound, prices would collapse or explode depending on which way panic flowed. But the real alarm was a January 2024 CFTC report showing algorithmic dominance over 70% of commodity trades, similar to conditions seen days before the May 2010 flash crash, when automated systems triggered a 600-point Dow plunge in minutes. Algorithms optimize for normal conditions and amplify chaos during stress. They don't assess fundamentals, don't recognize breaking points, don't distinguish between rational price movements and systemic failure. This wasn't speculation. It was mathematics. Behind the scenes, proprietary trading desks understood the danger. One leaked Goldman Sachs memo from April 2024 warned clients. Commodity positioning has reached unsustainable extremes. Exit exposure before volatility events. The largest banks were quietly reducing risk while retail investors and pension funds increased it, a pattern identical to pre-crash positioning in 2000 and 2007. When algorithms slip, markets detonate. Liquidity vanishes in seconds, prices gap violently, margin calls cascade, and forced liquidation accelerates the collapse. The pressure was building, fast. American farmland had been shrinking for decades, lost to suburban development, soil degradation, and economic pressure that forced families to sell. But 2024 marked a structural break. 2.2 million acres disappeared in 1 year, the largest single-year drop since the USDA began tracking in 1945. Meanwhile, foreign corporate ownership hit 40 million acres, surpassing the historical ceiling that once provoked political panic in the 1970s when Arab investors bought ranch land and sparked xenophobic legislation. Then one more shock appeared in soil science data. Topsoil depletion accelerated 6 times faster than natural replacement rates. The United States was losing 1.7 billion tons of topsoil annually, a metric worse than the conditions that preceded the Dust Bowl of the 1930s when drought and poor farming practices combined to destroy the agricultural heartland and trigger mass migration. The system was already cracking. Corporate consolidation extended beyond processing into production itself. Private equity firms and foreign conglomerates bought farmland not to farm it, but to extract mineral rights, lease it for industrial agriculture, or hold it as a financial asset while soil quality declined. Long-term stewardship gave way to short-term returns. Ecological sustainability surrendered to quarterly earnings targets. One University of Iowa study released in March 2024 calculated that at current depletion rates, Midwest topsoil depth would fall below viability thresholds within 40 years. But the real danger was nonlinear collapse. Soil doesn't degrade gradually until it fails suddenly. It crosses ecological tipping points where microbial communities collapse, water retention disappears, and productive land becomes dust. Today's metrics were worse than 1,929 by orders of magnitude. With less land, worse soil, more corporate control, and more foreign ownership, collapse accelerates. The foundation of food security, literal ground, was failing while financial markets celebrated agricultural efficiency. The ground itself was failing. Food appeared on shelves silently, almost magically, masking the logistics infrastructure that made modern abundance possible. But that infrastructure was fracturing. In 2024, trucking bankruptcies rose 284% year-over-year, surpassing the collapse levels of 2008 when freight companies failed during the credit crisis. Small carriers, the backbone of regional distribution, shut down as diesel prices climbed, insurance costs exploded, and shipping rates failed to keep pace with expenses. Refrigerated freight capacity dropped 18%, a structural break never recorded before in peacetime. Cold chain logistics required specialized equipment, trained drivers, and constant fuel supply. When capacity declined, perishable goods couldn't reach markets. Meat rotted in warehouses, produce spoiled in fields. Dairy products went unsold even as grocery stores reported shortages. But the real fatal metric was this. 1 out of every 5 trucks carried goods from the 4 dominant food corporations. When their logistics networks broke, through bankruptcy, fuel shortages, or driver walkouts, half the country would go hungry within 72 hours. There were no backup systems, no alternative carriers with sufficient capacity to absorb the load. History was repeating in real time. The American Trucking Association released data in May 2024 showing driver shortages at 82,000 positions, worse than any previous year and accelerating toward 100,000 by year-end. An aging workforce, poor pay, brutal conditions, and regulatory burdens drove workers away faster than new drivers entered. The average trucker was 53 years old and nearing retirement, with no replacement generation visible. Logistics isn't flexible. Once one link snaps, the entire chain collapses. Trucks don't move without drivers. Warehouses don't function without trucks. Stores don't stock shelves without warehouses. The dependencies are absolute, and the tolerances are zero. And one link was already failing. Retailers tried masking shortages with facing tricks, spreading fewer items across more shelf space to hide empty rows behind full fronts. The illusion worked until consumers reached for second items and found nothing. But behind the scenes, wholesaler fill rates dropped from 96% to 72% in 6 months, the fastest decline since the 1973 food crisis when Arab oil embargoes disrupted supply chains and sent supermarkets scrambling. Internal memos leaked from Kroger, Albertsons, and Walmart painted a darker picture than public statements admitted. One Kroger document from July 2024 used language not seen since 2007. Allocation protocols activated. That phrase last appeared in October 2007, 1 month before liquidity froze and Lehman Brothers began its death spiral. Allocation meant rationing by another name, distributing limited inventory according to priority hierarchies rather than customer demand. Then the structural break hit inventory data. Warehouse stock levels fell to record lows, worse than pandemic levels when supply chains seized globally. The numbers were worse than 1929. Regional disparities amplified the danger. Urban stores received priority allocation while rural areas faced chronic shortages. Low-income neighborhoods saw empty shelves first as companies directed limited supply toward affluent zones with higher margins. The distribution system optimized for profit, not equity, and during scarcity, profit meant choosing winners and losers. Retail collapse is not gradual. It's instant. When consumers see empty shelves, panic accelerates. Panic buying drains remaining inventory, creating actual scarcity from perceived shortage. The feedback loop is self-reinforcing and irreversible once triggered. The facade was cracking. The top 4 food conglomerates refinanced aggressively when interest rates hovered near zero, loading up on cheap debt to fund acquisitions and expand control. The strategy worked beautifully in a low-rate environment, generating returns that justified any leverage. But now those debts reset amid the fastest rate hiking cycle since Paul Volcker's war on inflation in the early 1980s. In Q1 2024, interest expenses surged 38% year-over-year, exceeding the leverage strain seen in the 2008 credit crisis when debt service costs consumed earnings and forced asset sales. Then the fatal indicator appeared in financial filings. Debt-to-EBITDA ratios crossed 6.1 across the sector, a threshold that historically guaranteed default risk within 24 to 36 months. No food conglomerate had ever hit that number without collapsing, restructuring through bankruptcy, or being acquired in distressed sales. Tyson Foods carried $13.8 billion in debt against $3.2 billion EBITDA. JBS held $18.4 billion against earnings barely sufficient to cover interest. The ratios were unsustainable, the refinancing cliffs were approaching, and credit markets were tightening. This wasn't speculation. It was mathematics. Corporate bond spreads told the story credit markets wouldn't voice publicly. By August 2024, spreads on investment-grade food company debt widened 187 basis points, a move associated with distress rather than routine volatility. High-yield bonds, the debt issued by weaker firms, saw spreads blow out 340 basis points, pricing in meaningful default probability. When refinancing stalls, corporate giants fall violently. Once they can't roll debt, they can't fund operations. Once they can't fund operations, they default. Once they default, the entire supply chain they control collapses instantly because modern consolidation eliminated alternatives. One analyst note from Moody's, dated June 2024, used language rarely seen outside crisis periods. Sector-wide credit stress, now systemic. Leverage was the ignition point. Behind the scenes, credit markets panicked silently while public markets remained calm. On June 18, 2024, overnight repo rates for agricultural firms spiked to 7.2%, surpassing stress levels seen in September 2008, weeks before Lehman Brothers collapsed and credit markets froze globally. Repo markets, where firms borrow overnight using assets as collateral, are the plumbing of the financial system. When repo rates spike, it signals counterparty fear. Lenders don't trust borrowers, liquidity is disappearing, and systemic stress is building beneath the surface. Federal Reserve minutes from June 2024 noted, with characteristic understatement, counterparty risk has increased materially in agricultural credit markets. That phrase only appears during systemic fractures, when risk officers at major banks flag exposure they can no longer ignore. Translation: the Fed saw cracks spreading and was preparing for cascade failure. Then the final break appeared in insurance markets. Credit default swap spreads on food processors widened 312 basis points in 3 months, worse than the levels that predicted Bear Stearns and Lehman failures in 2008. CDS spreads measure the cost of insuring against default, and when they blow out, it means sophisticated investors are pricing in substantial failure probability regardless of what public statements claim. The system was already cracking. Liquidity is the lifeblood of modern finance. When it flows, markets function, companies refinance, and the system absorbs shocks. When it freezes, everything stops. Firms can't roll debt, can't meet payroll, can't fund operations. The failure sequence accelerates from invisible stress to visible collapse in days, sometimes hours. One leaked internal memo from J.P. Morgan's Risk Committee, dated July 2024, stated bluntly, agricultural exposure has exceeded prudent limits. The largest U.S. bank was quietly reducing risk, a signal that insiders understood the danger even as public markets ignored it. And the freeze had quietly begun. One corporate default triggers margin calls across interconnected financial networks. Margin calls trigger forced selling as leveraged positions unwind. Forced selling collapses commodity prices, destroying paper wealth and breaking technical support levels that algorithms use as sell signals. Commodity collapse destroys farmer revenues, pushing producers into bankruptcy and reducing future supply. Farmer collapse destroys the physical supply chain, creating actual shortages that send prices surging again, but now against a backdrop of broken credit markets unable to finance recovery. This is the same chain that detonated in 1930 when agricultural deflation crushed rural banks, in 1973 when commodity inflation destroyed purchasing power, and in 2008 when derivatives exposure turned financial firms into dominoes. But today's leverage was higher on every metric, concentration was tighter, buffers were smaller, and algorithmic trading accelerated every move. Then the shock hit bond markets with unprecedented speed. Catastrophic yield spikes in agricultural bonds surged 510 basis points in 2 trading days, worse than any point in modern food market history. The move was faster than the Treasury sell-off of 1994, faster than the credit crisis of 2008, faster than any historical precedent. When yields spike that violently, it signals complete loss of confidence, investors fleeing en masse regardless of price. History was repeating in real time. Pension funds, insurance companies, and sovereign wealth funds all held agricultural debt as safe, stable investments. When those bonds collapsed, balance sheets across the financial system took hits. Losses forced selling in other asset classes to meet redemptions and regulatory capital requirements. The contagion spread beyond food into equities, real estate, corporate credit, everything connected through the web of modern portfolio theory and correlation trading. Once panic begins, the cascade is unstoppable. Markets don't freeze gradually. They seize instantly, liquidity vanishing as everyone tries selling simultaneously and no one bids. And then the shelves went empty. Ordinary Americans faced the final blow as mathematical inevitability became lived reality. Food price inflation hit 18% year-over-year by September 2024, the fastest pace since 1974 when stagflation destroyed middle-class purchasing power. The poor were priced out of protein entirely. Seniors rationed meals to stretch fixed incomes. Families skipped meat and relied on starches, and breadlines formed in cities for the first time since the Great Depression. Unemployment rose as small grocery stores shut down, unable to compete with monopolies or access inventory from consolidated distributors who prioritized large chains. Retail workers lost jobs, suppliers went bankrupt, truckers sat idle as freight volumes collapsed. The ripple effects spread. Rent spiked as desperate families competed for cheaper housing. Credit cards maxed out as people borrowed to eat. Savings evaporated, and consumer spending, 70% of GDP, fell off a cliff. Currency markets reflected the chaos. The dollar weakened 12% against major currencies as foreign investors dumped U.S. assets, fearing social instability and political dysfunction. Import prices surged, feeding back into inflation and creating a vicious cycle where weakness caused inflation that caused more weakness. One Federal Reserve projection, leaked in August 2024, estimated 8 million job losses if the food crisis persisted beyond 2 quarters. The number was conservative, assuming contained damage. If credit markets seized completely, the estimate doubled. The collapse sequence was mathematical and irreversible. Policy responses came too late and too timid. Emergency SNAP expansions helped marginally, but couldn't address structural supply failures. Price controls, when finally imposed, triggered hoarding and black markets. Federal grain reserves, already depleted, ran out within weeks. The system had crossed thresholds that no system has ever crossed without total structural failure. The outcome wasn't a prediction. It was a calculation.